All right, today we're diving into an absolute giant, Benjamin Graham's The Intelligent Investor. Now, let's be clear, this isn't some get-rich-quick scheme. Not at all. This book is the blueprint for building a rock-solid mental framework for investing, a framework that's designed to protect you from making huge mistakes and help you build a real, long-term strategy. It's really a manual for an unshakable mindset.
And if you need any proof of its power, just look at who gave it the ultimate stamp of approval. Warren Buffett, who was actually Graham's student, called it by far the best book on investing ever written. I mean, that's not just praise, right? That tells you these ideas are timeless and they absolutely work.
So how are we going to break down this masterpiece? Well, here's the game plan. First, we'll look at the huge difference between being an investor and being a speculator. Then, you're going to meet up, let's call him a very moody business partner, Mr. Market. After that, we'll talk about how to build your own investor's fortress. And finally, we'll get to the heart of it all, Graham's central concept, the margin of safety.
Okay, first things first. Graham makes you answer a really critical question right at the beginning. Are you an investor or are you a speculator? He believed that most of the disasters on Wall Street happen because people honestly don't know the difference.
And the line he draws in the sand is crystal clear. On one side, you have speculation. That's all about trying to time the market, following the latest hot trend, getting caught up in hype and emotion. It's basically chasing prices. On the other side, you have true investment. This is about valuing a business, doing deep, thorough analysis, making sure your initial money is safe, and looking for a reasonable return. The scary part? So much of what people call investing these days is really just pure speculation.
And this right here is Graham's non-negotiable definition. Just look at the 3 pillars. Number 1, it has to be based on thorough analysis, not some tip you heard from a friend. Number 2, it promises safety of principle, which means you're protected from losing your shirt under any reasonable scenario. And number 3, it promises an adequate, not an insane, but an adequate return. If what you're doing doesn't tick all 3 of those boxes, guess what? It's speculation. Period.
Graham is constantly warning us that emotion is basically gasoline on a fire for a speculator, but it's poison for an investor. As he put it, that kind of enthusiasm on Wall Street almost always, invariably, leads to disaster. The second you get swept up in all that excitement, you've stopped thinking like you own a business, and you've started acting like a gambler.
And boy, is history just littered with stories of even the smartest people falling for this stuff. I mean, Sir Isaac Newton, one of the most brilliant minds ever, lost a fortune in the South Sea bubble. Even Graham himself got burned early on. And if you look at more recent history, the dot-com bubble was just wild. You had companies like VI Linux go public at $30 a share, skyrocket to almost $240 on the very first day, and then poof, collapse down to just a few bucks.
For a perfect, almost comical example of this madness, just look at 3Com during the dot-com bubble. They spun off their little subsidiary Palm. The market went so crazy for Palm shares that its valuation implied the rest of 3Com, all its profitable core businesses, was worth less than nothing. In fact, it was worth negative $22 billion. It makes no sense. It was pure insanity.
So, if the market can be that irrational, that crazy, how on earth are we supposed to deal with it? Well, Graham's answer is that we first have to figure out where the real risk is coming from. And trust me, it's probably not what you think.
So who is it? Is it crooked CEOs? Wall Street analysts with their own agendas? Is it the market itself? Graham's answer is profound, and it's shockingly simple. He says the worst enemy is you. It's us, our own emotions. He argues that the biggest danger in investing isn't the stocks. It's the person clicking buy and sell. Our very own human nature is the #1 obstacle to success. To help us deal with ourselves, Graham created this absolutely brilliant story, this allegory. Meet Mr. Market. So imagine you own a piece of a business, and you have this partner named Mr. Market. Every single day, without fail, he shows up at your door. And he's a total emotional wreck, just manic-depressive. Some days he's euphoric, totally giddy, and he'll offer you a ridiculously high price for your share. But on other days, he's in total despair and offers you a pathetically low price.
The secret, Graham says, is to remember who's in charge. Mr. Market is your servant, not your master. You don't have to listen to him. You are totally free to just ignore his daily quotes and get on with your life. His only job is to serve you opportunities. You can buy from him when he's freaking out and selling low, and you can sell to him when he's way too optimistic. You profit from his madness. You don't join in.
So, how do we actually defend ourselves? How do we build this fortress against Mr. Market's wild mood swings and, more importantly, our own worst impulses?
Well, Graham gives us a set of simple, business-like rules.
These 4 principles are the bedrock of your fortress. First, know your business. I mean, really, truly understand what it is you own. Second, don't just blindly hand your money over to other people and trust them. Third, focus on the real-world results of the business, not on some pie-in-the-sky speculative dream. And finally, once you've done your homework, have the guts to trust your own research, especially when the crowd is screaming that you're wrong.
And this leads us to another one of Graham's most powerful metaphors. In the short run, he said, the market is basically a voting machine. It's just a popularity contest, tallying up which companies are hot and which are not. But in the long run, he said, it's a weighing machine. It eventually figures out the true substance, the actual weight of a company. Your job as an intelligent investor is to ignore the votes and focus on the weight, because you know that eventually the market will catch up.
Which brings us to the final, and I mean the absolute most important piece of this whole puzzle. Graham himself said these were the 3 most important words in investing. This is your ultimate shield against mistakes, bad luck, and all the chaos of the market.
The margin of safety. It sounds kind of technical, but it is a beautifully simple idea. All it means is that you only buy something when you can get it for a price that is significantly below what it's really worth. And he figured out that worth, what he called its intrinsic value, by looking at real stuff, a company's assets, its balance sheet, its reliable earnings, all to get a conservative estimate of what it's truly worth.
Let me put it this way. Let's say you do your research and you figure out a business is worth $1 a share, but Mr. Market is having a bad day and he's willing to sell it to you for just 60 cents. Well, that 40-cent difference, that is your margin of safety. That's your cushion. That's your protection. If you were a little bit wrong in your math, or if the business hits a speed bump, that margin is what saves you from losing money.
And this leads to a wonderfully backward-sounding conclusion. In most of life, right, we think higher reward means taking on higher risk. But in Graham's world, it's the exact opposite. The bigger your margin of safety, that is, the cheaper the price you pay compared to its real value, the greater your potential reward is, and at the same time, the less risk you're actually taking on. It's an amazing idea.
So, when you boil it all down, what's the big takeaway from The Intelligent Investor? It's that you can't get rid of risk, you can't predict the future, and you know what? You don't have to. Real successful investing is all about building a disciplined system to manage risk, to control your emotions, and to always act like a business owner.
At the end of the day, Graham shifts the entire focus away from the market and puts it right back on you. Risk isn't some scary monster out there. It's something you control through your own preparation, your own homework, and your own discipline. So the real question isn't, is the market risky? The question is, are you prepared?